So, Andrew, a couple questions. The mortgage industry, the banking industry, it's changed quite a bit with rates. So, what's the mortgage market like today?
Yeah, so it's quite a bit different today than what we were seeing 6 months ago, even 12 months ago. Um, and I think one of the key things that we need to understand is kind of the difference between the variable and the fixed rates. So if I can explain that for a second, it'll give us an idea of kind of where the market is right now and where it might be going. So the variable rate mortgages are based directly off of the Bank of Canada prime rate. When the Bank of Canada prime rate changes either up or down, that directly affects your variable rates. So as far as variable rate mortgages go right now, they're high because the Bank of Canada, of course, they've had 8 consecutive increases to the prime rate trying to get inflation under control. So when we look at 6 months ago compared to now, um, quite a big difference in where the variable rates are at. Your fixed rates are based off of the bond market and actually have nothing to do with the Bank of Canada prime rate. And that's a question that I get all the time. Prime rates going up, where are fixed rates going? Well, the fixed rates aren't exactly linked to the variable rate. So sometimes they'll do nothing. Sometimes they'll go up when the prime goes up. Sometimes they'll go the opposite direction. So it just so happens that right now fixed rates are also high based on where the bond market is at. So both rates right now are high. What I'm seeing as far as what people are taking for their mortgage, right now there's nobody that's taking a variable rate mortgage. I mean, why would you? The rates are 1%, and in some cases more than 1% higher than a fixed rate. So why would you start with a high rate that could potentially even go higher from here? So right now, most people are taking a fixed rate. And that fixed rate has shifted even in the last 6 months to a year. I mean, traditionally, in my 23 years, the most popular mortgage rate is a 5 year fixed. Year over year, 5 year fixed. What's your rate? Without even knowing what term they're asking about, I know it's a 5 year fixed. That's always been the most popular. That's shifted in the last 6 months. My most popular rate right now is a 3 year fixed rate. And the reason for that is that the popular belief is that although rates are high right now, the popular belief is that in the next 2 to 3 years, those are going to start to come down. So rather than people locking in for a 5 year term, they're locking in for something lower. And that's why we're seeing this big shift right now to a 3 year fixed rate mortgage.
So that's quite a bit different than 12, 18 months ago. I mean, the variable rate was so low at one point. That must have been a big portion of your business.
Yeah, there were a lot of people that were taking variable, but even when I look to 6 months ago, 12 months ago, the 5 year fix was still the most popular because if we roll the clock back 6 months to a year, the it was almost equal to what the variable was doing at the time. So people were saying, I think a lot of people understood that rates were going to be going up at some point. Now, certainly nobody saw them going up to the degree that they did, but I think everybody realized that we couldn't sustain those low rates and that at some point they would start to come up. So I still had a lot of people taking a 5 year fixed, knowing that that rate was pretty well equivalent to what a variable was at the time, but knowing obviously that it wasn't going to increase over the 5 years.
Yeah, and rates have gone up significantly, but if you take a look at the historical trend, they are still relatively low compared to 15, 20 years ago. Just people got used to 5 year money, 2% or less, but in the big picture, they are still relatively low.
Absolutely. Absolutely. This is just a matter now of, I think, the Canadian public kind of wrapping their heads around the new norm. I mean, where we're at right now is more normal than it's been in the last, let's say, 5 years. You know, when you were getting a fixed rate for lower than 2%, that was not sustainable and that was not normal. The same way as in the 80s, you had double digit rates. That wasn't normal either.
Yeah. But I guess there's a whole group. I mean, if you're of a certain age, you've never seen anything higher than 2-3%. So you bought a house and it was 2-3%. You didn't know any different. You only heard the stories from some of the old guys about the rates being 10, 12, 14% in the 80s or
Exactly.
90s. I remember having a friend that I told him when rates dropped below a 5-year fixed, you could get it under 10%. I said, you better lock in.
Yeah. Yeah, and a lot of us do remember that, but you're absolutely right. A lot of your first time home buyers, you know, even the ones that haven't bought yet that are shoppers, this is new to them and they're shocked because to
Yeah.
them the norm was around 2%.
So Andrew, if we have clients that are ready to purchase from a financial point of view, what's your recommendation? What's your next steps?
I think the very first step, as soon as you start thinking that you may want to buy, is to get in contact with someone like myself and take a pre approval for yourself. Take an application with someone. Uh, Pre approval is very important for two key reasons. Number one, it'll let you know how much you can afford before you go out shopping. And that's very important because I find that, you know, a big mistake that a lot of first time home buyers, second home buyers make, they assume how much they can purchase. Maybe they've just calculated on a website somewhere and just have a general idea, and then they go out and shop. Problem is, once you actually do get around to taking an official pre-approval with somebody, if that number's different, and specifically if it's lower, it's going to be very difficult to find something in your price range. If you're human nature, if you start looking in a higher price range, and now all of a sudden you realize for whatever reason you may not qualify for that, and you've got to go down maybe 25,000, 50,000, whatever it is. Human nature is you're not going to like anything in that lower price range, even though there's probably plenty of good stuff out there in that price range. Once you've looked at the higher price range, you don't like anything in that lower price range. So that's number one. The other thing that a
Very true.
pre-approval will do for you is it'll lock in a rate for you. And a lot of, RBC has a 120-day rate hold, meaning that once you do take an application with someone like myself, we're then able to guarantee that rate for 120 days. Meaning that when you go out and are shopping and you find a place, your offer is accepted, you know what your rate's going to be. It guards you against rate increases. Now, of course, if rates are a little bit better by the time you buy, then that's a bonus. But at least if you start shopping and rates do start to creep up on you, you've got the assurance of knowing that you've got a rate locked down for that purchase that you're looking at.
When you mentioned, Andrew, that 120-day pre-approval, when you say that the client has to have an offer, does it have to close within that 120-day period, the purchase?
Correct, John. Yeah, it has to close within 120 days from the time that you took that pre-approval.
So going back to the time frame, Andrew. So 120 days. Once you've got your rate, it's good for 120 days. Before you get that rate, so when we have clients, and quite often this happens, we get clients who, as you say, jump out there. They want to go start looking at homes, and they're not pre-approved yet. What's the time frame on that in your estimation to get pre-approved?
Well, I always say, like, as soon as you start looking at something. So if you start looking at MLS listings, um, and in your mind, if you say to yourself, if the right place comes along, I'd be willing to make an offer. That's the time to get pre-approved. Right from the kind of initial as soon as you're thinking about buying, that's when you should get a pre-approval. And yes, it's you may not purchase in the 120 days, but it's very easy to renew a pre-approval. I've got clients that I've been working with for a year, and in some case 2 years, that haven't found a place. And every 120 days, we just keep renewing that pre-approval for them. So as soon as the thought process is, if I were to find the right place, I'd make an offer. That's the time to get pre-approved.
Okay, so but just to shorten up the time frame. So once I've had clients that have young first time buyers, they're eager to get out there, and they see a house that catches their eye on Realtor, and they're contacting me and they want to go see it and perhaps put an offer, but they're not pre-approved yet. So if I was to call you up, say, Andrew, I've got a client needs a pre-approval. Here's their information. How soon could you make that happen?
Oh, very quickly, very quickly. I mean, I don't work in a branch anywhere, as I'm sure you can tell from the background here. So
Okay.
I'm what we call a mobile mortgage specialist. So I'm available. If I get a call, if I get an email, and somebody needs a hand, I'm going to be calling them as soon as I can. And we're able to do these applications remotely, right? So by WebEx or right over the phone, we can get something put together for them so that they've got some comfort in knowing that they're going to have some financing in place with their offer.
Okay. Okay. Good to know.
It's just, yeah, for sure. But we kind of want to try and get ahead of that, just so that people aren't rushing around, right? Trying to get me all the information that I need in a span of a couple of hours before they make an offer. Can it happen? Absolutely.
And you are kind of tied up, as you mentioned, to the client getting you the information that you require. You can only go as quick as they get you the information.
Exactly. Yeah. But
Okay.
again, that normally comes together pretty quickly, right? Like we're talking, in most cases, you're looking at a 20 to a 30-minute phone call, and we're able to get something put together for them.
When I have clients, you talked about shopping around. Obviously, they're shopping around for houses, but I also mentioned to them shop around for your mortgage. And I usually say, if you're comfortable with your bank, start with your bank. Go and talk to a mortgage specialist, somebody like yourself. Can you maybe touch on the difference between a mortgage specialist and a broker? Because I do know a number of brokers as well.
Yeah, absolutely. So, when you're talking about a broker is somebody that's able to deal with different lenders, right? And some of those are banks, a lot of them are non-banks. Whereas a mortgage specialist like myself, I'm an RBC employee. So when you're talking to me, I'm looking at at options specifically with RBC. And I think what's important for your clients to know is it's fine to see what a broker can offer, but the other difference is RBC does not deal with mortgage brokers. So if first of all, if you're an RBC client and you want to know what your bank can provide, a mortgage broker is not going to be able to provide that option for you. So in order to look at all of your options, you'd want to talk to both a mortgage broker and someone like myself who's a mortgage specialist with RBC. That way you're getting an RBC option and you're also getting options potentially somewhere else. So that's the key difference. I'm an RBC employee, whereas a mortgage broker is not tied to any one lender. So, a mortgage broker will tell you, well, we're able to get you a better rate because we're dealing with different lenders. I mean, the reality is that your own bank's probably able to be very competitive as far as the rate goes, regardless of what the broker might be finding out there.
And as you mentioned with RBC, if I had a client who was with Scotiabank or BMO, could they knock on your door and get a rate from you?
Absolutely. Absolutely.
We have weekly meetings with Remax Hallmark, Andrew, and our meeting this week, we have some partners on there that give different scenarios. And one came up where an agent had a client that was pre-approved for, let's just throw some numbers out, for $950,000. I guess I'm not sure who they got that with, but the agent was surprised at that. I'm not sure. I don't know any of the information why he would have been, but he asked them to get a second opinion. So they went and got a second opinion, and I'm assuming originally they only talked to somebody at the bank and not necessarily a mortgage specialist as yourself, and then they got pre-approved for 1.2 million. And when I heard this story, I thought that's ridiculous. That's $250,000 difference. That's a huge amount when you're shopping for a house. Can you maybe expand on that a little bit?
Yeah, so it can go either way, and in that situation there, great. It turned out that they actually qualified for more than they originally thought. I guess the horror story can be somebody that thinks they were pre-approved for a higher amount, and then now all of a sudden you're looking at a $200,000 difference. So we pride ourselves at RBC in doing our due diligence first of all with an application. So you've got, for someone like myself with 23 years of experience, I know what I'm looking for when I'm talking to people, and I know when to maybe ask a few more questions, because that's the other thing, right? Like when you're talking to somebody taking an application, if you're kind of misinterpreting what your income is, which isn't hard to do for people that aren't normally used to taking an application and divulging what it is that they make. Something as simple as including bonuses in a salary that you make, right? And just assuming that that's the salary that you make. Well, those are two different things. Salary is looked at one way, and then your bonuses are looked at another way. So again, it's about the experience of the person that they're talking to, and knowing when to get some more information, when to ask some more questions on a person's situation. The other thing that RBC really prides itself on is if we move forward from the pre-approval, because the pre-approval is really, we're looking for red flags with a client, and if there are any, we want to make sure they've got good credit, they've got the income to support the mortgage that they're taking, that they've got the down payment available to them. And as long as there's no red flags there, that's what the pre-approval is. It's like, okay, we're holding a rate for you, go out and shop. It doesn't eliminate the need for a financing condition on an offer, because what will happen is, of course, when your offer is accepted on a place, that's when we convert that pre-approval into what we call a firm approval. And RBC really prides itself on these firm approvals. And what that means is that at the time of offer, we're doing an appraisal on the place if it's necessary. We're doing that up front. And we're submitting all of your documents up front, meaning that once that gets in front of an underwriter and once it's approved, it's firm. And that's really important for people to realize, because it means that there's no problems at closing. We're not going back closer to a week or two before closing to actually do an appraisal on the place and figure out whether or not this is a place we want to finance. Okay. We're doing all that legwork up front. And that's really important. When you've got your approval from RBC, it's good as gold. We're funding that approval for you at closing. And I only say that because you hear horror stories in the industry of lenders, individuals that will work with different lenders, and they'll say you're approved, but the legwork hasn't been done. Like I mentioned, they're doing an appraisal maybe 2 weeks before closing, right? They're looking at your stuff and saying, yeah, well, I'm sure we'll have a lender for you. It's okay. You can waive your financing. And they're worrying about it later. It's not something that we do at RBC. Like I said, we're looking at everything up front and doing all that legwork up front, so that when you waive that financing clause, you're going to be okay. You're going to have a mortgage with RBC at the end of the day.
Good. Great info. Thanks for sharing all your knowledge.
Thanks, guys.